Hi everyone, John here. Over the last few videos we have looked at the price tag of a stock using the PE ratio and we learned how to check the engine using profit margins and debt. But today I need to warn you about the dashboard. Because on Wall Street net income is often a legal friction. Accountants can manipulate earnings, stretch out depreciation, and make a dying company look highly profitable on paper. But there is one thing they cannot fake, and this is the cash in the bank. Today, we're going back to our well-known pizza shop to learn about the ultimate reality check, free cash flow, and the tool the pros use to value it, the discounted cash flow. So, let's start with the lie. Joe gets a massive catering order for a corporate office and he delivers 5,000 bucks worth of pizza. The accountant immediately writes down 5,000 in revenue and 2,000 in net income. That makes Joe look rich on paper. But here's the catch. A lot of the time, just like now, the corporation bought the product on credit. They tell Joe, we will pay you in 60 days. So Joe has 2000 in paper profit, but his operating cash flow is zero. When his delivery driver asks for his paycheck on Friday, Joe can pay him. And if he runs out of actual cash, he goes bankrupt, no matter what the income statement says. For our example, let's say that Joe makes 20,000 in operating cash flow this year. That's cold hard cash sitting at the register. But suddenly his main pizza oven, no surprise there, breaks down. He has to buy a new one for $5,000 just to stay in business. And this is called capital expenditure, or CapEx for short. And you should have heard this term a lot with the current AI boom. Um, So when we take his 20k cash flow and subtract his 5k capex, we're left with $15,000 in free cash flow. This is the holy grail of investing. It is the pure, unadulterated cash that Joe can put in his pocket, pay out as a dividend, or use to buy a second shop, let's say. Now that we know that Joe produces real cash, we're ready for the hardest question in finance. How much should you pay to buy the pizza shop today? For today, we will keep it simple. So let's say that Joe makes 10,000 a year in free cash flow. Let's assume that the shop stays open for exactly 10 years and then closes for some reason. Uh, so 10,000 a year for 10 years is $100,000. Should you pay Joe $100,000 to buy his business right now? The answer is no. Of course, no. Excuse me about that. The answer is no. And because of a concept called time value of money. A dollar tomorrow is worth less than a dollar today. So if Joe hands you $10,000 today, you can reinvest it, beat inflation, and grow it. But if Joe makes you wait 10 years to give you that 10,000, inflation eats its purchasing power, and you lose out on 10 years of investing it elsewhere. This is where the DCF, the discounted cash flow model, comes in. We have to take his future cash and discount it back to what it is worth right now. The actual formula looks scary, but the reality is simple. The little r is your discount rate, basically the return you demand for waiting. Let's use 10%, a nice market beating number. In year 1, Joe gives you $10,000. Discounted by 10%, that's worth $9,090 today. In year 5, you have to wait a long time, so that $10,000 is only worth $6,209 today. And by year 10, inflation and opportunity cost has eaten up almost the whole amount. That $10,000 you would be making in 10 years is only worth $3,855 today. So when you add up all these discounted years, you realize Joe's shop isn't worth $100,000. Ideally, you should pay no more than $61,445 for it today. This is exactly what the Wall Street analysts do day in and day out. When you buy a share of Microsoft or Meta or whatever, you aren't buying a ticker, you're buying a stream of free cash flow for the rest of the company's life. A DCF model just predicts what those future cash flows will be and discounts them back to today's price. If the current stock price is lower than your DCF value, you should buy. If it's higher, you should walk away. As always, you can take a screenshot of this. Please tell me what you want to talk about on our next episode. Comment, like, subscribe, and I'll make sure to see you next time.